You know how they always say, don't just give someone a fish, teach them how to fish? Well, today I'm here with just that kind of content. Actually, from now on, we'll have content like this every Tuesday. I'm going to try to help you become better investors. We'll cover a lot of topics from balance sheet analysis to technical analysis, from what it means to have the right investor mindset to the basic principles. In this context, today we're going to talk about 18 essential investment principles. I try to follow these principles strictly. Of course, I'm not always successful. Being human, I often let my emotions take over. But whenever I return to these 18 investment principles, whenever I hold on to them, that's when success comes.
I'm picking up trash equal to my subscriber count. Do you want to join this good deed too?
You'll see in the presentation that there are lots of great visuals. I owe these visuals to Brian Feroldi. Brian Feroldi has a fantastic ebook called 99 Powerful Financial Lessons. It means 99 powerful financial lessons. You could easily download this ebook yourself as well. I'll leave the link below. Following Brian Feroldi will also really help you become a better investor in general. I find his content very insightful. Now that we've thanked Brian Feroldi, let's get started with the 18 essential investing principles. The first fundamental principle is to be a long-term investor. Unless you're ready to spend 14 or 15 hours a day in front of a screen, live a crazy stressful life, and kill yourself trying to master technical analysis and extreme detail, it's smarter to choose long-term investing over short-term investing. There are some exceptions to this. We'll get to that in a bit. Also, what you invest in for the long term is really important. I'll touch on that a little bit in a moment. But basically, if you're a part-time investor like me, in other words, if you have other jobs and just want to make the most of your money on the side, then long-term investing is definitely the better solution for you. Especially if, like me, you're investing in the American stock market, because the American stock market is one that always trends upward in the long run. Here, you can see the movement of the S&P 500 index since 1999. Of course, there are sharp drops in between, but the overall direction is always up. I can't really say the same for the Turkish stock market. In the Turkish stock market, the index has basically been flat for the past 20 or 25 years. In the Turkish stock market, picking the right stocks becomes really important. In the American stock market, since the overall market goes up, as long as you don't make really bad choices, you always make money in the long run. There's also a way to put this into numbers.
I'm picking up trash equal to my subscriber count. Do you want to join this good deed too?
For example, when we look at the S&P 500, most people who invest for just one day end up losing money. A smaller portion of those who invest for a year lose money. That's the section labeled lose money right here. If you've invested for 10 years, you're very likely to make money. That's the yellow section. If you can wait 20 years, you make money 100% of the time. Who waits 20 years? Real investors like Uncle Warren Buffett do. You need to do the same. And here, in a humorous visual, Brian Feroldi says, yes, there is cheating in the stock markets. In which direction? In favor of protecting long-term investors. If, like me, you focus on technology companies, the long-term becomes even more important. Because it takes time for these companies' technologies to prove themselves, to be accepted by customers, and to expand. Look, NVIDIA has been producing AI chips for about 3 or 4 years now. They have GPUs, but things only started to pick up speed this year. Why? Because everything takes time. Both the development of the technology and its adoption. Along with being a long-term investor, the second principle is to focus on time, not timing. What do I mean by that? I see it. We have friends like that in our WhatsApp group too. There are also people who comment to me on social media. Professor, is it a good idea to buy this stock at this price? Should I sell now? You think the stock market will correct next week? Will it go up next week? Everyone is obsessed with perfect timing, buying at the very bottom and selling at the very top. Unfortunately, that's not a realistic plan. And when we look at it, the real key to success is staying in the market for the long term. So instead of trying to time the market, it's about making time in the market, being able to stay in for a long period. Time in the market. When you choose this approach, your mind starts to relax a bit more. I see a lot of investors trying to consume data in a panic every single day. What kind of price movement happened with that stock? Which resistance level did we break here? What did Powell say today? There's an incredible amount of noise. But if you look at the long term, you actually calm down. Because if you've invested in the right asset for the long term, it's guaranteed to go up. What does the right asset mean? The right asset doesn't just mean making the right stock market investment, it means picking the right stock. We'll get to that in a bit. Now, this brings us to the third most important principle. And here, I completely agree with Brian Feroldi. The way to make money is to invest in good companies and wait for a long time. This visual explains the issue really well. It says here, buy good companies and keep your investment in them until they're no longer good. What does this mean? Every company's performance can decline over time. Management changes, products become obsolete, a new technology comes along. That's why the buy and forget philosophy isn't the right one. We'll touch on this again in a bit. But if you buy a good company and hold it for a long time, as long as the company stays good, it will bring you profit. This is the main point Brian Feroldi's making here. When you buy a good company, the worst decision is to sell it quickly. I see this happen a lot too. For example, the company releases its financial statement. This happens in our WhatsApp group as well. The company goes up by 10%. People immediately say, let's sell and take the profit. But if you've invested in a good company and that good company delivers a strong financial statement, that's a sign the company is on the right track for the long term. So why are you selling at that point? Of course, what does it mean to be a good company? What does it mean to remain a good company? What does it mean to hold a stock for the long term? These are topics that need to be thought about more deeply. In the coming days, there will be a lot of training on these subjects. Doing a proper analysis of the company is also extremely important. From what I've seen, most Turkish investors are only interested in the company's stock price. But that's just the tip of the iceberg. It's the part that's above water and visible to us. And that's just an outcome. An outcome of what? The stock price is the result of all these things: the company's balance sheet, cash flow, income statements, the opportunities offered by the market it's in, its business model, competitive advantages, pricing power, that is, its ability to get customers to accept its prices.
I'm picking up trash equal to my subscriber count. Do you want to join this good deed too?
Corporate culture, the risks it faces, its owners, and its management. And you invest just by looking at that. Oh, this one's dropped a lot, let me buy it. Or this one's gone up a lot, let me sell it. Most of the time you're wrong, because in the long run, these are the things that determine where a company is headed. You need to spend time on these, analyze them. Again, many Turkish investors, their investment criteria is just looking at the price to earnings ratio. The price to earnings ratio is really high. Isn't this expensive, Professor? The price to earnings ratio is just one indicator, and in many cases, it's not even the right one. I'm preparing a course on which indicator we should actually focus on regarding this. You're going to love it. Hopefully, it'll be available in a few weeks. As a long-term investor, I look at different things. For example, how's the brand? What about the CEO? How are the company's growth rates looking? How's it managing its free cash flow? Is the company's revenue recurring, or does it have to generate new revenue every time? What's this company's mission? What's the company's organic growth rate? What are this company's return on investment rates? Which industry are this company's technologies ready to disrupt? The things I look at are completely different. So proper company analysis doesn't mean saying the stock is going here or there based on technical charts, especially if you're investing for the long term. Maybe that's true in the short term, but from what I see with these textbook economists, they don't really get anywhere with that either. They shorted Nvidia. Look, which Nvidia are we talking about? They shorted this Nvidia. Of course, I've made mistakes too. Even I didn't expect this much from Nvidia. But by these criteria, Nvidia is an amazing company. Shorting this company is generally not a good idea. That's why, instead of focusing on technical analysis, you should focus on the fundamentals of the company. And if you have a company that's strong in these areas, you can be sure that its stock will go up in the long run. No one can predict short-term movements, but in the long run, the stock of a good company can't stay cheap. Now, there are friends who will say, but sir, sometimes the stocks of very successful companies drop mercilessly, or the stocks of very bad companies can rise very quickly. That's true. These things happen in the short time, because when we look at it, a company's valuation criteria can change over time. For example, if we look at just one day, algorithms are important. If, for example, a news report comes out on Reuters that morning saying production at Tesla's China factory came in 5% below expectations, the stock immediately drops. Why? Because algorithms kick in. Remember, in the United States, most stocks are bought and sold by algorithms, that is, artificial intelligence, and they only look at this. Sales numbers are down, sell this stock. When we look at things on a quarterly basis, analysts start to become more important, and I've given a lot of examples about this. Some analysts are actually just garbage, to be honest, but the stock market pays attention to analyst evaluations, and if an analyst upgrades a stock that day, in other words, raises their valuation, it can go up. Or the opposite can happen as well. But actually, analysts can be really wrong. When we look at a one-year period, the valuation multiple, that is the price-to-earnings ratio, becomes important. But when we look at 5 years, the truly important factors come into play. Is profit growth continuing? When we look at 10 years, is the speed at which the invested money is returned increasing along with profit growth? And when we look at 20 years, factors like whether the company has the right culture, the right people, and the right organization to sustain growth come into play. That's why if your stock unexpectedly drops on a given day, it's probably the work of algorithms. If at the end of the quarter an analyst says something in the financial report and the stock drops, but you know that the fundamentals of the stock are still solid, to me these are just noise. Another important topic is the balance between emotions and concrete developments. In the short term, the market is driven by emotions. For example, since the beginning of this year, the sentiment around Tesla has been really negative. Sentiment for Nvidia is extremely positive, but its value is rising too fast. Nvidia still isn't expensive, but it's gaining value quicker than it should. Meanwhile, Tesla's dropping unfairly. Why? The sentiment's bad, the mood's bad, the news and the media is bad, and the reports coming in are bad. Ultimately, none of this matters. In the long run, what Elon Musk says on any given day just isn't important. In the long run, the only thing that matters is whether the company's earnings are growing or not. That's why a long-term investor truly understands the balance sheet of the company they invest in. They understand the growth trends well. They know exactly where things are headed, what new technologies are coming, and which new growth opportunities these will create. Another important question is whether the company's price is expensive at its peak. It might be at its peak, but not necessarily expensive. Imagine an asset stable for a long time that suddenly shoots up. You think, it's gone up a lot. You say, I missed this, I can't get in anymore. Then I can break out and keep going. Because if a company finds ways to grow its profitability or convinces investors that it has, that stock will go up. We can never time the exact top or bottom of any stock. 6th basic principle, don't trade too much. You're constantly buying, selling. Don't do this. Think of it like washing your hands too much with soap as an analogy. What happens to the soap? After a while, it wears away. I've seen a lot of the downsides of frequent trading. Sometimes I get caught up in it myself. You need to trade less. If you've picked the right stock, all you need to do is wait. The visual here is really nice. It says that 99% of building wealth is just waiting. So save your money, make the right investments with it, and then just wait. 99% of investing is doing nothing. I say this a lot. For example, in our Had Den Ask Group's WhatsApp chat, there's always this crazy excitement. Before the market even opens, people are saying this stock went up, that one dropped. The Fed said this, Pablo said that. Which trade should we make? Should we buy or sell before the market even opens? I don't get caught up in this rush anymore. There's something I believe in. If I've made a good investment, I want to hold on to it for a long time, and all the noise in the market stops being something that concerns me. And when you look at it, there's actually a lot of evidence showing that people who don't trade frequently and hold their stocks for the long term get better results. So if you're not doing anything that day, that's actually a good thing. We don't need to do something every day, but we do need to study every day. Keep reviewing and researching every day, but making trades every day is extremely harmful. And don't forget, every time you make a trade, you pay commissions. And if you've made a profit, you pay taxes too. So why would you do it? Buy, hold, and wait. Honestly, most of the time, that's what you should be doing. And that brings us to the 7th important point. I invest in the company, not in the stock price. Even the stock prices of really good companies can sometimes drop for no good reason. Or sometimes the stock prices of really bad companies can go up for no reason at all. What I invest in is a good company. Look, this chart here is really nice. Here, we can see how a good company performs. In what sense? Its sales, profitability, growth. But the stock price can fluctuate like this. That's not something I care about. But if the company is going downhill, that's a different story. That's why I buy stocks that have taken a hit. For example, last year I bought PayPal for this reason. In November 2022, I bought Meta. Why? Because the companies were still doing well, but their stock prices had dropped sharply. For a certain reason, I buy these kinds of companies, but if the company's performance is declining, I don't buy the stock just because it's cheap. Why? Because sometimes there are real reasons why a company's stock drops, and the most important one is that the company's actual performance is getting worse. I'm not playing the stock prices. I'm trying to become a partner in good companies. Of course, to enter at the right time, you might need to do a certain amount of technical analysis. I'll explain these basic technical analysis principles to you in a future lesson. They've already benefited me. There are a few basic issues, but I don't stress about it too much. Because if the company keeps growing, if profits keep increasing, the stock will eventually recover on its own. Of course, there are some exceptions to this 7th principle. Sometimes, making moves based on price can make sense in the short term. For example, the social media platform Reddit just went public. The stock is moving extremely wildly right now. I'll show you in a bit. Here, you can do something based on the price. You could open a short-term trade. But this is an exception, and it's separate from our long-term investing. You should know that the risk is higher here, and you should act with smaller amounts of money. For these kinds of risks, like whether Reddit will go up or down or what it'll do in the short term, I sometimes prefer leverage trades, but I do this with very small amounts, because I know that in the long run, none of this matters. For example, I'm not a huge fan of Reddit as a company in the long term. That's why I don't see it as a long-term investment either. Again, in the short term, announcements can really affect us. That week, the company's earnings report might be coming out. Mr. Powell might be giving a speech. During those times, to be honest, I like short-term trades and I do them. Sometimes in indexes, sometimes in stocks.
I'm picking up trash equal to my subscriber count. Do you want to join this good deed too?
Because I'm trying to develop a prediction and act on it. But again, these play a very small role in my overall investments. Of course, there's an exception with altcoins. You can't really do fundamental analysis on most altcoins because they're not structures that generate free cash flow or have profitability like a company does. These are assets that rise and fall with market speculation. So maybe you can play the price game with these too. I agree with that. I mean, maybe with really strong coins like Bitcoin or Ethereum, longer term stories are possible. But for most altcoins, looking at them in the short term seems much smarter. I do these kinds of trades on QuantFury. QuantFury is also an investment platform that I collaborate with and that sponsors this channel. I do my trades on it with zero commission. I use leverage if I want to. It's honestly a very advantageous site. At the same time, I can also check my technical charts here. Here you can see Reddit's movement. After going public, there was a sharp rise, a drop, and then another sharp rise. So in my opinion, this is exactly the kind of asset worth investing in and trading on QuantFury. But let me say again, this is an exception for me. I'm a supporter of buy and hold for the long term, but from time to time we take advantage of opportunities like this. This is actually part of the fun, the joy, the pleasure of it. But overall, the money and time I dedicate to this is way less than you might think. Now we've come to the 8th principle. You need to put in effort and time to pick stocks. You shouldn't entrust your health or your money to anyone else. What did Bora Ozgen say about stocks? What did that American analyst say? None of that matters. You need to do your own analysis, and honestly, this is the part that requires some effort. In the coming days, I'll try to provide you with training on how to do more accurate analysis, but you absolutely need to learn how to pick stocks. You can use some tools for this. First of all, of course, you need to have some savings. You need to do research. You can have a certain checklist. In other words, you can develop principles about what makes you like a particular stock. For example, I like growth stocks. I keep a journal about this. I always have a notebook. I jot down any news published about the stocks I'm interested in. There are stocks that I follow. I mean, I haven't bought them yet, but they're ones I might consider buying. I try to look ahead to the future as much as possible. I have a vision about which company will be the giant of the future, and I can only invest when I truly believe in a company. If it's a company I don't fully believe in yet, but still want to be involved with for the long term, I keep my investments there very, very small and always stay committed to being patient. These are the basic principles of picking stocks. So what should you do? First, it's useful to learn the ticker symbol of a stock. Then, the name of the company. Feraldi summed it up really well here. Because there are people who don't even know this. Honestly, there are people who invest just based on the ticker symbol. They believe in it just because the stock price is going up. It's also useful to know the stock's performance. What is the company's business model? What opportunities lie ahead for the company? What is the company's competitive advantage? What do the company's financial statements tell us? How satisfied are the company's customers? How's the customer experience gone? How's the team? What is the quality of the management team? What are the company's risks? What kind of culture does the company have? You need to invest only after knowing all of these things. Just about every week, I analyze one or two stocks, or rather companies, within this framework and share my findings with YouTube channel members. You should become a YouTube channel member too. If you pay attention, not just to which stock I'm analyzing, but how I analyze it, it'll be very educational and beneficial for you. And remember, in the long run, your performance as a stock investor depends entirely on your skills. And in the short term, you might get lucky. It happens to me sometimes too. Or you might be unlucky, but in the long run, if you improve your stock picking skills, you'll definitely make better choices. The 9th important point is to monitor your investments. Now, sometimes I hear this in Turkey. Professor, just buy that stock and forget about it. That's not it. We don't just buy and forget. Conversely, some check prices daily, constantly swinging between excitement and panic. And damn, now that all of this is on our phones, on these apps, they keep checking it all the time, panicking, making moves, buying and selling. Both approaches are wrong. First of all, if you're checking stock prices too often, it's like staring at a forest. It's as if you've planted trees for yourself and you're watching them every day on a webcam to see if they've grown. That doesn't really give you any results, does it? Because when we invest in a company, we want it to grow step by step over the long term. Checking the price every day doesn't really fit with that goal. On the other hand, buying and then forgetting about it, just leaving it aside, isn't right either. Maybe the company's going downhill, its products aren't catching on, customer experience is deteriorated, or there's a problem with management. Honestly, we also need to keep an eye on these situations regularly. So we'll move forward with balance, but our focus should be on the company, not the stock itself. We'll look at whether the company is doing well or going downhill. That way we won't have any headaches. Also, don't get caught up in all the noise. There are way too many economists who just repeat what they memorized. They talked about this game all last year. Will the US stock market crash? Others say the opposite. The ones who always say it's going to go up. Constant wars, geopolitical developments, these are pretty far outside my area of interest. I'm trying to pick the right company and focus on what I can control. Did I pick the right company? Can I keep my nerves in check? Can I set aside enough money for this? If the money here shrinks for a while, will I be heard? So I try to focus on what I can control. All the noise in the market doesn't really interest me that much, because everyone has something to say. Honestly, most of it isn't very substantial. By the way, I use Seeking Alpha to properly track my investments. You should definitely use Seeking Alpha too, especially for stocks traded in the US. There's amazing information available. Financial statements, analyst opinions, valuation comments. I love it. I even make some of my charts there. Seeking Alpha will do the job for him. You have the chance to use it free for a week. After that, there's also a significant discount. The link is below. Make sure to start using it right away. Try it free for a week. You'll definitely see the benefits. The news section here is especially great. Almost every day, new updates about the stocks I invest in show up here. I read from there and see how things are going. Now, let's move on to the 10th point. Don't pretend to be a long-term investor. Look, we have a WhatsApp group in the Houdini As Club. By the way, if you want to join the Houdini As Club, the link is below. We'd love to have you there too. We discuss all sorts of things live there every day. And here's what I noticed there. Everyone acts like a long-term investor, but as soon as the price of a stock drops, they tend to sell, just like an analyst would. That's not what long-term investing is. Long-term investing means really knowing what you're investing in and staying in it for the long haul. And it's about being able to stick around not just in a bull market, but in a bear market too. I'm not saying that if the bear market gets rough, you should never sell or never set a stop loss. That's not what I'm saying either. But selling or buying right away means you're not embracing this mindset at all. But buying and selling immediately, trying to time the market, I really try to avoid that mindset. If I bought something, I want to hold on to it for a long time, and I know that very few people are truly long-term investors. Most people who claim to be long-term investors start to panic the moment the market takes its first dive. I see this in our WhatsApp group too. Today the market is deep in the red. People are saying we're ruined, it's over.
I'm picking up trash equal to my subscriber count. Do you want to join this good deed too?
No, guys, things like this always happen in the short term. In the long run, as long as there's no fundamental change in the overall market structure, I stick to my strategy. Now, let's move on to the 11th point. I completely tune out the perpetual bears, the ones who are always convinced the market will fall. Because I know that most of them are just doing it to become social media influencers. For some reason, I don't know why, people tend to gravitate more toward fear. When I tell you that a stock will rise in the long run, it's not that interesting. But if I say the market might drop today, then everyone pays attention. That's why, in my eyes, many of these so-called textbook economists are just charlatans. Constantly saying it will crash, it will die, this company will die, the stock will die, America will die. None of that means anything. In the long run, the only thing that matters is, did I invest in the right area? Is my investment thesis still valid? Is there anything that would break my investment thesis? That's why I draw on charts and saying there will definitely be a sharp correction from here. Ignore the buzz about how the world will give up on the US dollar. Sometimes these people might turn out to be right, just like even a broken clock is right twice a day. But aside from that, what they say is completely meaningless. What's even more interesting is that this brings us to the 12th point. Make money in bear markets. Why? Because in bear markets, you accumulate stocks. 3/4 of 2022 were a bear market. I'm wealthier today because I accumulated during those times. Right now, it's harder to make money because we've been in a bull market for a long time now. So when you look at the market, focus on bear markets. And when you look at a stock, if that stock has really taken a beating and nobody likes it, pay attention to it. Of course, that's only if the fundamentals of the stock are solid. That's why I like bear markets. Shelby Davis says, actually, you make your money in bear markets, but it takes time for you to realize it. In other words, the stocks you accumulate during a bear market make you money when they rise in a bull market. But for some reason, when we enter a bear market, everyone gets scared. Everyone stays far away from stocks. Then, when the bull market comes and stocks are soaring, people try to buy in. This is a common mistake investors make. 13th point. This is a particular problem among Turkish investors. They chase the bottom, like we saw with Meta. Meta's price dropped to $89. People said, if it goes down to 60, I'll buy. Tesla's price dropped to $100. People said, if it goes down to 60, I'll buy. Or maybe it will come down from there as well. But if this company is really a good company, why don't you buy it right away? Because yes, I understand you might be paying a little more than you should, but is that possible if that company breaks away and you miss out on a mega winner? Possible. Then there are these types. I'm waiting for a correction, then I'll get it. But when the correction comes, now it's too risky. Instead of all this, what you should do is regularly buy the assets you believe in. In other words, use dollar cost averaging. For some stocks, I buy every week with my eyes closed. I don't care what happens that week, because I know that sometimes I buy here, sometimes I buy there. When I buy at this level, I feel really good about myself. When I buy at this level, I feel kind of stupid. But if I believe that the company I'm investing in is a growing company and will turn into an even bigger, amazing company in the next 5 to 10 years, then all this noise doesn't matter to me. That's why making regular investments in a few companies gives better results than trying to time the market. The 14th point might be the most important one. Start investing right away. The best day to start investing was the day you were born. The second best day is today. Of course, this doesn't mean the following. It doesn't mean you should blindly go and put all your assets into stocks, take on debts, get loans, sell your house or apartment, and buy stocks. First, you need to do some preparation. What is this preparation? Take a look at your own financial situation. Get your expenses under control. Set aside some cash that you will never touch, separate from the money you allocate to the stock market. Have a fund for emergencies. Because if you don't do that, you end up making panic decisions. Folks say, Professor, I'm marrying in 3 months. They save for the wedding. They ask, what should I do? Don't do anything. Don't touch it. You might not even get married later. Short term, anything can happen in the stock market. Try to get rid of all your debts, maybe except for your mortgage. I think you should always have an individual retirement plan for your retirement. So have a calm, regular investment plan, make sure you have insurance, plan your career, and along with all that, start investing gradually. But honestly, the earlier you start, the much better. Because what I always tell myself is, if only I had bought Apple, Amazon, or Nvidia 20 years ago, well, today's the first day of a new 20 years, so it's worth starting to invest right away. The 15th topic is saving. It's a very, very important topic. Instead of making a sudden large investment, we need to invest in stocks regularly and consistently. In other words, we should always set aside a portion of the money we earn for investment. Feroldi expressed this very well himself. Typical people earn money, spend it, and then invest whatever's left over. Don't do that. Make your investment first from the money you earned and spend what's left over. This is very important. It's a key principle. This way, you'll see that you'll be investing regularly. Automating your investments can be a smart move in this regard. And don't forget this, especially in the early stages of being an investor, your savings rate is extremely important because it's impossible to get rich from a very small amount of money. But as the money you set aside grows, like, for example, as the number of shares you own increases, it becomes possible for you to earn more money. That's why saving is essential. After a while, once those savings reach a significant level, the rate of return on your investments starts to become important. 16th point, mental model. A lot of investors have a completely wrong mental model, thinking things like, I'm going to make money right away in the short term, or the market's doing badly, I'm ruined. That's not it. What you actually need to do is this. First, if the market's doing well, great, you're getting richer. Second, if the market is down, that's great too. The price of the asset you want to buy is going down. This is a very important mindset. Warren Buffett always emphasizes this point. He says, I'm very happy when the stocks I invest in get cheaper because it gives me a chance to buy more. But remember, if a stock price is going down because the company's fundamentals are deteriorating, that's not an opportunity. But if everything is in place, the company keeps growing, the stock price is just making a temporary move. That's the time to buy. And you'll make mistakes in a lot of your decisions. I make mistakes with a lot of stocks too. It's not a big deal. A few of those mistakes, or sometimes even just one, can make up for all the losses. That's why you should have a portfolio. Don't just stick to a single stock, but you also shouldn't make your portfolio too broad. You can't track everything, but it's impossible for all your picks to be right. What's important is that the gains from your right picks do what to the losses from the others? Make up for them. Let me give you another piece of advice about developing the right mental models. We have another website. It's called Kidop Expressi. We offer audiobook summaries there. It's completely free. The link is above and below. And we also have plenty of tips about being an investor there. These will also help you become mentally stronger. They'll help you control your psychology and focus on the right things. It's completely free. Go subscribe right now. You're going to love it. Every week we summarize a book. In about half an hour, whether you listen, watch the screen, or read the subtitles, you'll master that book. Here you can see some amazing books. The 17th fundamental principle, increase your earning power. Look, this is extremely important. Warren Buffett says the best investment you can make is in yourself, because that way you protect yourself against everything. What kind of investment are we talking about? Investing and increasing your earning power. New skills, new ventures, all of these are absolutely critical, because only if the money we earn increases can we direct more money into investments. It's very hard to get rich just from investing itself. But if my income increases and I can put more money into investments, then it's possible to build wealth from investing too. In this context, improving ourselves is truly critical. Let me give you another piece of advice. On May 7th, my dear wife Pinar is holding a training on solo entrepreneurship. I highly recommend you join. By the way, there's also a discount code. If you send an email to hadinias@oskent.co, we can provide you with a discount code as well. How are solo businesses created here? I'm still basically like a solo business myself. So how can you start a small business based on your own skills? It's actually a course that covers great topics, like how you can do this while working at a company at the same time. I definitely recommend you join. And now let's get to the last and most important point. 18th point. Investing in stocks is only one part of your life. It's extremely important to manage your whole life properly. That's why you should invest in improving yourself. You should invest in your relationships. You should invest in your physical and mental health, because these are your truly most valuable assets, not stocks. Your family, your health, your self-confidence, doing a job you genuinely enjoy, your free time, your friendships. These are the things that really matter.
I'm picking up trash equal to my subscriber count. Do you want to join this good deed too?
Don't compromise too much on these. Investing in stocks should be something that strengthens all these valuable assets. It shouldn't be something that steals your time from them or ruins them. That's why I don't really recommend short-term trading. It can be very mentally exhausting. When you invest for the long term, you feel more at ease mentally too. So those are the 18 points. I know this one turned out a bit long. It felt a bit too much like a lesson, but I hope you liked it. If you did enjoy it, I could really use a like right now. If this video gets a lot of likes and views, I'll prepare awesome lessons for you every week. Also, if you write in the comments which topics you'd like lessons on, that would be great. That helps guide me too. Take care with love. Goodbye. See you soon.